Good day, everyone. I am Clarice Joy Blancha, and I am the first reporter of Group 4, together with Gumuno Tortor, Villanueva, Galvez, Bucar. So, our first topic is valuation ratios. So, what is valuation ratios? So, valuation ratios, sometimes called market value ratios, are measurements of how appropriately shares in a company are valued and what type of return an investor may get. By calculating the market value, a potential investor can see if the shares are overvalued, undervalued, or at a fair price. It also helps determine how much a potential investor should buy.
Hi everyone, I am Arjun Galvez and I am going to report the per share or EPS. So what is EPS? Earning per share is calculated as a profit divided by outstanding shares of its common stocks. The resulting number serves as an indicator of a company's profitability. It is common for a company reports that is adjusted for extraordinary items and potential share dilution. The higher a company's EPS, the more profitable is considered to be. So, earning per share is commonly a net profit divided by the number of common share it has outstanding. So, EPS indicates how much money a company makes for its share or its stock, and is widely used for metric for estimating corporate values. So a higher EPS indicates a greater value because investors will pay more for the company's share if they think the company has higher profit relative to each share price. So next we're going to tackle about the formula and calculation for earning per share. So earning per share value is calculated as net income, also known as profit earning. So it is divided by available shares, and more refined calculation adjusts the numerator and denominator. For shares that could be created through options, convertible debt, or warrants. So the numerator of equation is also more relevant to its adjusted for continuing operations. So to calculate a company's EPS, the balance sheet and the income statement are used to find the period end number of common shares. So dividends paid on preferred stock and the net income or earnings. It is more accurate to use weighted average number of common share over the reporting term because the number of shares can change over time. Any stock divided or split that occurs must be reflected in the calculation of the weighted average number of shares outstanding. So some of the data sources simplify that the calculation by using the numbers of shares outstanding and the end of period.
Good day, my name is Angela Nicole Tortur and I will discuss the multiples valuation ratios. Multiples valuation ratios are used by financial analysts to calculate the value of a company. These ratios can be used to determine the share price of a company going public, a target price for an equity research report, or if a company is under or overvalued relative to its peers. A. Price ratios. Use the most recent company share price to drive insight about company value for financial analysts. These ratios are quick to calculate but can be affected by different accounting policies and treatment. B. Enterprise value ratios. Enterprise value ratios are calculated using a company's enterprise value to drive the valuation process. These ratios measure the return on a company capital investment. Many enterprise value ratios also isolate earnings from accounting affected items such as interest and depreciation. Next is price to earning ratio. The price to earnings ratio compares a company's stock price with the earnings per share. This ratio is commonly used as valuation metric to compare the relative value of different companies. The PE ratio shows the expectation of the market and it the price paid per unit of current earnings. And here are the formula of price to earning ratio. The next is interpretation. To calculate this ratio, the following formulas are required. Earnings per share equals net income, preferred dividends, weighted share outstanding. Companies with a high PE ratio are often considered growth stock. This indicates positive future performance and earning growth as investors are willing to pay more per dollar of a current earning. However, growth stocks are usually more volatile and more investor pressure to perform well. Stock with high PE ratio may also be considered overvalued. Conversely, companies with a low PE ratio are often considered value stock. They are undervalued relative to their competitors and company. The PE ratio can also be used to compare stock at different prices. For example, if stock A is trending at $30 and stock B at $20, stock A appears to be more expensive. However, if stock A had a lower PE ratio than stock B, its price per unit for earnings would be lower than stock B, thus making stock A cheaper from earnings perspective.
The enterprise value over earnings before interest and taxes. The ratio compares a company's enterprise value to its earnings before interest and taxes. Enterprise value over earnings before interest taxes is commonly used as a valuation metric to compare the relative value of different businesses. While similar to the enterprise value over earnings before interest taxes, depreciations and amortization ratio. Enterprise value over earnings before interest taxes incorporates depreciations and amortizations. And here is the formula. Enterprise value over earnings before interest and taxes. For the interpretations, to calculate this ratio, the following formulas are required. Market capitalizations equals share price times number of shares. Net debt equals market value of debt minus cash and cash equivalents. For the enterprise value over revenue ratio is a ratio that compares a company's enterprise value to its revenue. The enterprise value over earnings before interest, tax, depreciations, and amortization ratio is commonly used as a valuation metric to compare the relative value of different businesses. Enterprise value over revenue is one of the only performance related to multiple valuation ratios available for companies with negative earnings before interest, tax, depreciations, and amortization. For the formula, enterprise value over revenue equals market capitalization plus net debt is equivalent to enterprise value over revenue. For the interpretation, to calculate this ratio, the following formulas are required. Market capitalizations equals share price times number of shares. Net debt equals market value of debt minus cash and cash equivalents. So we will now discuss the valuation ratios comparison. For the enterprise value over sales price, it is widely used and understood, quick and easy to source info and calculate, useful to check DCF exit assumptions. For the cons, depends on corporate structures, accounting policies impact earnings. For the enterprise value over earnings before interest, tax, depreciations, and amortizations pros, it incorporates profitability, expands comparable universe as most companies are EBITDA positive, ignores all significant accounting differences from goodwill, limited exposure to accounting differences. For the cons, ignores depreciations, capex, tax regimes, and tax profiles. Does not account for varying earnings before interest, tax, depreciations, and amortization growth rates. There may be inconsistencies in treatment of earnings before interest, tax, depreciations, and amortization for joint ventures in different reporting environments. Other accounting differences such as revenue recognition and operating leases. For the enterprise value over earnings before interest, tax, pros incorporates profitability. Useful for capital-intensive businesses where depreciations is a true economic cost. Good for companies in the same reporting environment where accounting differences are minimized. And for the cons, ignores depreciations, capex, tax regimes, and tax profiles. Does not account for varying EBITDA growth rates. There may be inconsistencies in treatment of EBITDA for joint venture in different reporting environments. Other accounting differences such as revenue recognition and operating leases.
Hello, good day everyone. I am Villanueva Kiana Jane. I will be the one who will report the dividend payout. So, dividend payout calculates the share of income the company returns to its shareholders as dividends. So, dividend payout equals annual dividends per share over earnings per share equals dividend paid over net income. Typically, the higher the ratio, the higher the proportion of income that equity holders receive. But finance professionals consider companies that return more than 50% of their earnings unstable. If earnings decrease, the organization must cut dividend payments immediately, hurting its share price. The dividend payout ratio is proportion of company's net income that is paid out as dividends as form of compensation for common and preferred shareholders. Typically expressed as percentage, the dividend payout ratio depicts how much of a company's earning paid out to shareholders as opposed to being retained and reinvested into operations, which has significant implications of type of investors that are attracted to stock. So here are the formula for dividend payout ratio. Dividend payout ratio equals to dividends divided net income. For example, if a company issued $20 million in dividends in the current period with $100 million in net income, the payout ratio would be 20%. So payout ratio equals to $20M divided by $100M equals to 20%. To interpret the ratio we just calculated, the company made the decision to pay out 20% of these net earnings to shareholders via dividends. On the opposite end, the company's retention ratio is 80%. So retention ratio equals to 1 minus 20% equals to 80%. Putting this all together, the company issues 20% of its net earnings to shareholders and retains the remaining 80% of net income for reinvesting needs. So another formula for payout ratio is equals to dividend per share equals earning per share. In short, DPS or EPS. So if the same company issued annual dividends of $1 per DPS or dividend per share with $5 in diluted EPS or earnings per share, the payout ratio also comes out 20%. So payout ratio equals $1 DPS divided by 5 DPS equals to 20%. Yet, another alternative method, we can calculate the payout ratio as the 1 minus the retention ratio. In our example, the payout ratio calculated under this third approach is once again 20%. So, payout ratio equals to 1 minus 80% is equals to 20%. So, we have here another example of dividend payout ratio calculation. So for modeling exercises, we'll begin by listing out the initial model assumptions. So, year 0 financial. So, net income is 200M. Dividend distributed is equals to 50M. So, the retained earnings equation consists of net income minus the dividends distributed. Thereby, the retained earnings for 0 is 150M. So retained earnings year 0 equals to $200M. Net income minus 250M dividends distributed is equals to 150M. Then, considering the payout ratio is equal to the dividends distributed divided by the net income, we get 25% as payout ratio. So, payout ratio year 0 is equals to 50M dividends distributed divided by 200M net income is equals to 25%. For entire forecast from year 1 to 4, the payout ratio assumption of 25% will be extended across each year. As a side calculation, we'll also calculate the retention ratio, which is the retained earnings balance dividend by net income. So, retention ratio year 0 is equals to 150M retained earnings divided by 200M net income is equals to 75%. To summarize, the 25% payout ratio indicates that 25% of the company's net income is issued to equity shareholders, whereas 75% of the net earnings are kept each period and rolled over and accumulated into the next period.
Good day everyone, so I'm Hazel Bukao. So I am the one who will continue to discuss about dividends valuation ratios. So let's begin. So what is the dividend valuation ratios? Well, the last set of metrics focuses solely on investment income per share and disregard capital appreciation. They cannot be used for companies that do not pay dividends. The following are the two common used dividend ratios. Next one is the dividend yield. Dividend yield measures the return per share in the form of dividends. It helps investors understand how much cash return a given share would yield. So, trailing DP equals for most recent dividend divided by market price, or lending DP equals forecasted dividends divided by market price. So, the higher the ratio, the higher the returns. So, similar to P evaluation ratio, so dividend yield multiplies can be trailing or lending.
And that's all. Thank you.